Hey guys, Toby Mathis here, and today we're going to talk about 7 mistakes people make with LLCs all the time. I'm going to break them down into little pieces so that you can understand what we're talking about and give it some context. But let's just put it in kind of like the 10,000 foot view. People set up LLCs quite often for asset protection, for estate planning, for tax planning. And by setting it up incorrectly, they undo a lot of these things that they're intending, simply because they just make pretty basic mistakes. And so let's just break down and kind of go over 7 that I see reoccurring periodically. These are for non-advanced people or for the advanced people. You might say, hey, these are pretty basic. Yeah, these are the ones that everybody screws up. So when you go out and you try to do it yourself, these are most common. So we're not going to even get into the deep dive of the operating agreements and the language that you can goof up on. This is just really the low-lying fruit. And the most basic, number one, is they put the wrong kind of income in the wrong kind of entity. So there's really breaks down to 3 different types of income. I go over this all the time on our tax and asset protection courses. There's active income, there's portfolio income, and there's passive. And they each have their own tax treatment, and you got to understand how they interact and how you can, for example, sometimes make your passive losses, which ordinarily only offset passive income, but how you might be able to make it non-passive. So you can use it against portfolio income and your active income. And so all these things do start to interact, but you can really screw it up by putting it in the wrong type of entity. So one of the things that I see quite often is when people set up an LLC, they might say, oh, I understand that I need to formalize my business. And they look at it and say, okay, I know it can't be me, so I'll set up an LLC. And they set up what's called a disregarded LLC, which means the IRS ignores it. And as a result, 100% of their income might be active income. All of a sudden, they're in a situation where they could have reduced their taxes considerably by filing one document. Let's say we make an S election. Let's just say it's a sole proprietorship. Let's say it's a business. I won't even say sole proprietorship. It's just you and your business. It's you LLC or me LLC, right? You're setting up a business. Say it's plumbing business, pizza business, whatever it might be. Airbnb could even be the business, right? And you have $100,000 of net income coming in. It's what you live off of. The difference between setting up the appropriate tax form is the difference between paying 100% of that income, 100% of the 100,000 as active income, which is subject to self-employment taxes. Boom, you didn't even know that. Oops. What are self-employment taxes? It's old age, disability, and survivors, which is 12.4%, Medicare, which is 2.9% added up. It's 15.3%. You get a slight deduction. So the math works out to it's a 14.1% tax on that 100,000. Could I reduce that? Absolutely. By simply choosing the right type of entity. We'll get there, right? But they don't understand the type of income in the first place. So they toss it in there. Or you toss something in that's passive. Let's say you have rental income coming through and you put it into something like an S Corp, and your accountant's going to get all over you saying, hey, you need to take a salary out of an S Corp. Your distributions can't be 100%, when realizing that, hey, that's passive income. Why did I put it into something that's appropriate for an active entity? Plus, if I take the property out to refi it or something like that, that's a taxable event in an S Corp, right? And you're saying, S Corp, he's talking about an LLC. Time out. We're going to do this weird thing where we talk about the LLC. Here's what the IRS sees when you say LLC. They go like this. I have no idea what you're talking about, because there's no such thing as an LLC to the IRS, right? What they see is there's either a default, which is if it's just you, it's a sole proprietorship, or if it's more than one person, it's a partnership. Or you could say, hey, treat it as a corporation, but there is no tax form for an LLC with the federal government. There's no magic tax form like there is for a corporation. Like if you're a C Corp, it's 1120, right? If it's a individual operating their business, it's just going to be a Schedule C on their 1040. So by not knowing the type of income you're putting in there, you could screw it up and make it taxed that otherwise wouldn't be. So for example, passive income is not subject to self-employment tax. If all of a sudden you have to take a salary out, salaries are active, now you have to pay the Social Security tax on it. Self-employment tax, all the same thing, right? You're paying old age, disability, and survivors and Medicare. So we don't want to force ourselves to pay that extra tax if we can avoid it. And it's just not knowing the type of income. So that's number one. I just say That's numero uno, is they screw up by not knowing the type of income that's going in the LLC, and they end up using an inappropriate entity for the type of activity they're doing. Numero two, right? Let's go to number two, is they set it up too late. Hey, I'm going to flip a property, so I buy the property and then I set up the LLC. Let's not do that. Let's set up that LLC before we take title, because if you're going to take title, you don't want your name sitting on title if you can avoid it. If there's a way possible to where your name does not show up in the public record with regards to that property, you go for it. If it's investment property or a flip or a business for that matter. Hey, I'm going to open up a pizza shop, right? Don't open up the pizza shop as yourself and then incorporate it. Incorporate, then open up the pizza shop. Why do you do that? Because you're trying to isolate the liabilities. By putting it in your name opens up the door as to when that liability occurrence was, whether you have personal exposure, now you're in chain of title, all those things. And immediately people are going to say, yeah, but my bank requires, if it's real estate, I got to close on my name. If you're flipping properties and you're not working with a lender that's going to allow you to close on the entity, look around for different lenders, right? There's so much liability that comes with things like flipping that you want to make sure it's not touching your individual name, if at all possible. And then even afterwards, I would say this is, so there's 1 and 2, we're on 2. This would be like 2A or 2B, which is shut down that entity after you're done. You're doing something that has a lot of liability with it. Get it done, get your money, close it down, right? And move on, do another one. They're not that expensive to set up. So set them up. That's what their reason is, what their existence is. It's to isolate that liability. They work well with estate plans, and you can use them for different tax treatment. They're a Swiss Army knife of taxation. But at its core, you're paying the state for protection. Don't undo that by not using the state for that protection, right? The whole idea is I use the LLC so I'm not personally liable. So don't do stuff and make yourself personally liable. And then when you close it down, don't do stuff that makes you personally liable. Get rid of that entity. It's done. Bye-bye. Give it away. That way you can ignore anything that comes down the pike after it. Other fun things they do, they set up an LLC and they do not create its own employer identification number. So we see that quite often. It's almost impossible to bank. Actually, it is impossible to bank, but they don't set up and create its own separateness. So if you're setting up an LLC, and you want asset protection and you want it to be treated separately from you for estate planning or for tax planning, it's got to have its own employer identification number. So you and I, as individuals, have social security numbers. Businesses have an EIN, an employer identification number. If you do not give it its own social security number, where does it default to? It's got 2 thumbs and sitting right here, right? It's me. I become my business. And the more that I am my business, and there's no distinction, is the more likely it is that they're going to ignore it and just look at you instead. Because if I don't respect my entity, no court's going to respect that entity. So you have to respect that entity, and you respect it by creating its own EIN. And that's going to lead us into number 4, which is they don't utilize that business as a separate business. And there's all sorts of reasons you do that. Number 1, hey, I might be able to sell it. Number 2, I might be able to have credibility on its own. And what do I mean by credibility? Credibility means things like banks and credit cards might give you credit because it's a separate business. Now, a lot of times they're going to rely, there's 3 things you always look at when you're dealing with credit: cash, collateral, or credibility. If you have any one of those 3 things, you're going to get credit. So you have a brand new business, think of it like a teenager. It doesn't have any credibility, so it better have cash or collateral. So if you're buying real estate, there you go. I can lever the real estate. I have some collateral. Maybe it goes that way. If it needs credibility, they're going to look at you for a little while. They might say, hey, you know what, for the first couple of years, you got to sign off on this stuff. Maybe they use your credibility as a guarantor on a credit card, and they still report it as a business credit card. And eventually, hopefully, you're no longer a guarantor, right? You can get to that point after you have enough credibility. If you have cash, people say, well, what are you going to do with cash? I'm going to buy a CD or put it in a CD, and then I'm going to get a line of credit against it to the business until such time as they don't need the CD anymore. So rather than just put money in the company and say, hey, I put money into the LLC, right? And I funded it. Yay. Put money in the LLC so you can fund it. Get a line of credit, like put that in a bank in the name of the LLC, by the way, and get a CD and allow that to be collateral against that line of credit until such time as they no longer need the collateral. Once you have enough credibility, they'll release that requirement, usually 2 or 3 years. And now you have a line of credit in your business, and you can take the money back out if you put the money back in. Or sometimes you don't even have to put the money in. You can just pledge your own CD and say, hey, you can lien that, because there you go. I'm going to sign my personal CD that's sitting there, and you can use it as collateral. The bank will do the paperwork to do that, so that they know that if the business does not pay back its line of credit, they have a CD that's covered it for security. No different than a HELOC or anything like that, a home equity line of credit. It's like they have the house that they can sell if you don't pay it. So, so that's number 4, right? Number 5 is books and records, making sure that you have actual separate books and records. Now, here's the dirty little secret. It doesn't matter whether you're an LLC, a corporation, a partnership, or an individual. Books and records are a requirement whenever you're in investor activities or business activities. There's no difference between those entities. There's more books required for a corporation. No, it's all the same. You got to keep track of the income and expenses. And keep in mind that when these requirements came out, QuickBooks didn't exist. People used to do it on a ledger. They used to do it in pencil. Like, as long as you're keeping track of your numbers, you're okay. I don't care whether it's an Excel spreadsheet where you're keeping track of these things, or you're using a program like QuickBooks. At the end of the day, it's the same no matter what. And where people will screw up an LLC is they just treat it as them. They don't create separate books for it, and they don't account for it separately. And just think about this. If it's using your bank account and your credit card and you're doing everything, doesn't it seem like maybe the courts are going to look at this and go, wow, there's no difference between this person and the other? Now, there is kind of an exception to the rule when you're in real estate and you got a lot of properties and they're all held by a holding entity. There might not be a reason to have the bank account. It's not something called dispositive. In other words, it doesn't nuke your entity. But when it's you as the sole owner and you're doing everything in your bank account, it looks really bad, and it opens up that door for an equitable argument called piercing that you don't want to come anywhere near if you're setting up that LLC. So how do you avoid that? You set up the LLC right. You do like we talked about in point number 3, which is you set up the EIN, you get a bank account, and you keep separate books. There you go. There's lots of benefits that come along with that, but it also keeps it separate from you, so that the benefit that you paid the state for, which is, hey, I want to make sure that I am getting asset protection, and I want to make sure that I get the right kind of asset, I get the best asset protection. I want to make sure that I'm getting everything I paid for. Don't undo it by being lazy on these things. Keep separate books and records. When I say records, I mean minutes of your meetings, which just means that if we removed you from the situation, is there a paper trail that explains what that LLC was doing? Can we see what it decided to do when it decided to do it? And usually there's a paper trail. Like in real estate, there's always a paper trail, because you're going to have these signed documents. So there you go. You have records on it. It helps if you have minutes of a meeting, or you have notations, or you have everybody agreeing to do something. Like if you have partners, you say, hey, we're going to acquire this unit here, and everybody says, I agree, that's a great idea, then you go buy it. So you have a HUD, you have a purchase agreement, and you have these notes that might even be in an email. Those are records. It doesn't have to be this magic, I want my minute meetings, and it has to be thou shall therefore, Robert rules of conduct, all that stuff. No, if you're just a me LLC, it's just you, it's just your business. Just make sure there's a paper trail. So if somebody comes behind you, they could say, what were you deciding to do? And can we see a paper backup? Same thing with books and records. It's just making sure that there's a record. Or same thing for books. It's making sure that here's income, here's expense. And thinking of that, let's go to number 6, which is make sure that if you are incurring personal expenses on behalf of that LLC, that you're adequately reimbursing yourself, and you're keeping a note of what you're reimbursing for. So for example, if you're in real estate and you're using let's say you're paying contractors, make sure that you have a record of who you paid and why. If it's a contractor, this will go with our next point, but make sure that you have that W-9. If you have expenses like, hey, maybe you have a cell phone, maybe you're driving a car or whatever, and you're reimbursing yourself, make sure that you either have an accountable plan. If you have an accountable plan, this could be a corporate entity. If you don't have an accountable plan, make sure you're documenting that it was specifically used for that item. Like if you go out and you buy things for a rental property and reimburses you, say, here's what I reimbursed for, get a copy of the receipt, put it in there. So if there's ever a question, they know that money came out to you as a reimbursement, not as income. So just make sure that you are doing that appropriately. It's just documenting. It's just as simple as a couple notes, what it was, why it was, when it was, how much it was. right? And make sure that you are keeping some sort of written record of it, even if it's on a spreadsheet or it could be on a calendar, whatever. Just make sure that when you're reimbursing, you're explaining why it is. You're not just handing cash, and then you can't remember 2 years. Let's say you get audited, they go back 3 years. You could be 4 or 5 years into the future, and you're trying to remember what you did 5 years ago. Good luck. You got to have a written record. And then the last thing I'll say, and this kind of mirrors with point number one, which was the types of income, is make sure that you use the appropriate tax form for the type of LLC you're using. So if it's an LLC and it's ignored, it's ignored. You're going to use the owner's tax form, which might be your 1040. It might be that it's going to another entity. It might be that it's going to a partnership, for example, in which case you're not doing a tax return for the LLC. It's all of its information, all of its books are going to get reported. All of its income and expenses are going to get reported on its owner, which in that case would be a partnership. So let's say you had an LLC real estate holding company. Let's say you used Wyoming because it's smart to do so, and you had a Wyoming partnership LLC. You use a 1065 for that LLC, and then it has 6 or 7 LLCs under it owning pieces of real estate around the country. Okay, each one of those, what does it need to file? If it's disregarded, they wouldn't have any federal filing. There might be a state, but there's no federal filing. So there's no tax return there. It's all going to end up on that 1065. So you have to think of your structure and say, here's the entity structure, but what's my tax structure look like? Do you know that I could actually set that same scenario up? Let's say we set up a Wyoming LLC that is owned by you, disregarded, and it has 20 LLCs underneath it that are disregarded and owned by that LLC. Whose tax return does that all end up on? It's you. You own the parent, you own the holding company, and the holding company owns all of the sub LLCs, and they're all disregarded. It means we're ignoring everything you set up. Even though there's 21 LLCs, it's all going on page 1 of your Schedule E if it's real estate, right? So, or, whatever type of business you might have, it might all end up on your 1040. You have to respect the different tax forms. So here, I'll just go through them real quick with you. When you have an LLC, it's either going to be ignored, which means it goes under the owner's tax return. If there's more than one owner, it's going to be a partnership. That's the default, which is a Form 1065. If it's a corporate entity, you're going to be either an S Corp or a C Corp. If it's an S Corp and it flows onto a return, it's going to file in what's called an 1120S, and it's going to give each of its owners, its shareholders, a K1 to report that income. It's kind of like, here's the income that we made. It goes down to the shareholders, which is the same thing that it does in a partnership. The partnership and the S Corp, the 1120S, the 1065s and 1120Ss, they are informational only returns. You don't pay a tax with them. And then it gives a K1 reporting the income and expenses. So it could be income and losses that are being reported to the owners of that organization. So again, so it could be an S Corp and it could also be a C Corp. C Corp's an 1120. C Corps pay their own tax. It's 21% flat right now, and that could go up, it could go down, it could go sideways, depending on what Congress does. Right now, it's 21%. And then if it pays out the profits that it pays tax on to the shareholders, those are taxed as dividends. But the tax form, just to get it out of the way, is that 1120. And then the last thing I want to focus on is, depending on who you're paying, maybe it's paying you, depending on the entity, you might have a W-2 or you might have a W-9. Or you might have a K1. It all depends on who you're paying. If it's a contractor, it's going to 99% of the time it's going to be you're going to be doing a W-9 and you're going to give them a 1099 if it's more than $600 a year. So if you have contractors working on properties and you pay them $1,000, $2,000 for a job, you're going to want to get a W-9 from them, which says, here's what my EIN is or my tax identification number. And then you are going to once a year give them a 1099 saying, here, IRS, I paid this contractor over here. If you pay payroll, if you're a sole proprietorship and you have nobody else working for you, you should not be doing W-2, period. You can't do payroll of your own sole proprietorship, nor can you do payroll on your own partnership. On the sole proprietorship, it just goes right on your return. 100% of the net income goes on your return, or net loss goes on your return. If it's a partnership, you get those K1s and it goes to the partners, but you do not pay yourself via a W-2. The only time the W-2 comes in is when you have corporations, and that's an S or a C Corp. If you are a single owner S Corp, you still pay yourself a W-2 wage, depending on if you're taking money out of the organization. And I didn't just misspeak. You don't actually have to take a W-2 out of a S Corp if you're not making distributions out of the S Corp. Technically, you only pay yourself a salary if you're taking the money out of the organization. So again, you're making $100,000 a year, you probably pay yourself a small salary, maybe 30, 40,000, and you'd pay the rest of it as a distribution out of the S Corp, and it would escape the dreaded Social Security taxes. That's how you do it. You save yourself quite a bit of money when you do things that way. And then if it's a C Corp, you're paying yourself a W-2 income out of that. If you're taking wages, sometimes you're just reimbursing expenses. Sometimes they're being zeroed out and there's not a lot of money in there. They don't have to pay you. But if you're going to take money out of that puppy, you're probably going to want to take a salary. And then if there's profits, you're going to be taking a dividend, and you're going to be 1099ing yourself on the dividend. I believe it's 1099 DIV or whatnot. You're going to be giving yourself, here's the dividends that I paid out on that C Corp as well. So we just went over a bunch of tax forms. If it was too fast, go back and listen to it again, or keep digging in. I got a lot of content on my website. Feel free to subscribe. And if you like this information, click the little bell, because it'll let you know when new videos come out. I'm always trying to dive in, and I also listen to your comments. So if you guys say, hey, could you get deeper into this topic? Quite often I grab that and it becomes the title of another video. If you know of anybody that could benefit from this information, please share it as well. And just know that we do a tax and asset protection event about twice a month, absolutely free. And my firm, just go to andersonadvisors.com and you'll be able to see where you can learn about land trusts, LLCs, corporations, and the tax treatment thereof, and including a little bit of legacy planning. Again, we do it a couple times a month, and they're very informative. They are all-day affairs, so be prepared. But they're kicking the pants, and you'll learn a lot. So thanks for watching. Please share it.